Hello, everyone. Welcome back to Investing Sucks. My name is Eric, and thank you so much for tuning in. So today we're taking a look at Equitable Group stocks. I've had a few people reach out to me and request that I cover this company, so I figured it'd be worth taking a look at. And remember, if there is any company that you'd like for me to cover, always feel free to drop a comment. Obviously, I can't guarantee that I'll cover every single company that someone suggests, as I do get many requests in the comments and also through email. But I do at least take a look at every company that people suggest to me. And if it does catch my eye, then I will cover it in a future video. But anyways, today we're taking a look at Equitable Group. This is a company that has delivered above average returns for over a decade now, as we can see on screen, just under 12% compounded over the last 17 years, which is quite significant. Now, I was curious to see if this rally was a result of more just investor optimism around this company. As we can see, a lot of this rally kind of came from a recent price surge in the most recent year and a half, of 18 months there, or if it was due to the business actually fundamentally getting better. So a good way to get an idea of this, because it is a bank, is to look at the price to book value. Banks carry a lot of assets on their balance sheet. They're typically valued using price to book, as it's similar to insurance companies, which we've covered a few times on this channel now. So if we take a look at the price to book value here, this gives us a chart so we can see how it's trended over the years. And let's go way, way back to see how it's been. So currently it's at about 1.3. Now that is actually historically high, as we can see if we draw a line across the chart. Usually it's below that. And we can see during the 2008 financial crisis, it went down quite a lot. And then also in early March of 2020, it went down a lot as well and was actually below 1 at one point. So that really shows what type of fear was baked into this stock price then, but it has recovered. So it kind of looks like this recovery was more just a reversion to the mean, and the business kind of being priced at what it has been historically rather than just pure investor optimism. But at 1.3 times book value, it is historically high. So clearly there is a bit of optimism currently baked into this company's stock price. So Equitable Group, which includes Equitable Bank, they have branded themselves as Canada's challenger bank, likely due to the fact that banking in Canada has long been an oligopoly for a while now, for about a century now. So clearly they think they're doing some innovative stuff. And from what I can tell, they do seem to have a very consumer-centric approach, and they have placed a pretty strong focus on fintech specifically. So a big part of this business is EQ Bank. This is kind of their consumer-facing side of the business, and they're talking about some basic metrics about how much it's grown recently. So they have their total number of customers, 240,000, which is up 60% year over year. So that's pretty strong growth. And then the more important metric would be deposits down here. We'll talk about why deposits for a bank is a very important metric. But we can see it's grown extremely fast. If we just go back about 2 years here, 72% compounded. And then they're also talking about these new types of services that they're creating, such as TFSAs, RSPs, which are all new accounts that they've rolled out recently. Although these don't really generate that much actual money for the business, it's really just fees that they can earn from these. Because they are a bank, most of the money that they're going to make is off of providing loans and making interest off those loans. And the way they get money to provide loans is from deposits. So the way you can look at EQ Bank is not so much it generating money through the fees, but it attracting customers and having customers deposit money there, because EQ Bank is a great bank that a lot of customers like to use. And if it does provide valuable solutions, then ideally you'll see more customers start to use it in the future years. So before we go any further, let's just define what makes a bank a good investment particularly, and talk a bit about the banking business model. So with any bank stock, really the value they provide from a business perspective boils down to how well they can, number one, grow their deposit base, meaning the amount of money that customers have deposited with them. And number two, how profitably can they deploy those deposits through a process called loan origination. So loan origination is when a bank uses the deposits they've received to make loans to different businesses or to mortgages. Reverse mortgages is another one that Equitable does. And that's essentially what the bank's profit is. It's the spread between the interest they pay on the savings accounts that the depositors have and the interest they receive from making these loans. And a key metric that is used by investors to evaluate banks is called net interest margin, which I have on screen here. It's basically just the interest differential divided by the average invested assets, which could be loans, for example. So more deposits and more savings held in EQ Bank, which could result from EQ Bank just providing good service, offering better solutions than traditional banking. That equals more loans that the company can make, which generates more interest income, which means more money and means a higher stock price. That's really what you're investing in here. You're investing in their ability to do those things and do those things well, and ideally not have the loans they make completely go belly up if the economy starts tanking or if there's some housing crisis that happens. So let's now take a look at what this actually looks like at Equitable Group. So firstly, they are a $2.3 billion company with their market cap. And then if we take a look at their financials and we can extend it back a few years. So let's go back to 2018 so we can get many years of data here. So this is what the income statement for a bank is going to look like. You're going to see the interest income on the loans, interest income on investments as well. Most of that is going to be for the loans. Like I said, with a company like this, I mean, they do have all these other services that they're rolling out, like TFSAs, RSPs, which is new for them. But where they make the vast majority of their money is from the interest here. That's really what's going to determine your success in a company like this. Obviously, those services are important for attracting customers because that grows the deposit base, which, as we talked about before, can then help increase loan originations. But ultimately, what it comes down to is this right here. So it has been growing at a pretty strong clip that we can see is interest income on loans, 206 million in 2011, and it's now surpassed 1 billion. So that's pretty strong overall. Net interest income is under 500 million in 2020, last 12 months. Again, pretty strong growth. So that's probably why the company is valued a bit high than what we'd expect when we looked at the price to book, how we saw it's higher than what it's been at historically. That's probably just reflecting the fact that the company is actually growing quite strong. And then down here, the non-interest income. So this would be the income from various value-added services like the TFSAs and the RSPs and that type of stuff. So total revenues is 600 million in the last 12 months. You can scroll down and look at the actual net income. So just under $300 million in net income. So for a $2.3 billion company, you're looking at on less than 10 price to earnings multiple, which seems low. That seems quite low, but it's a bank. That's one thing you have to keep in mind. And one of the reasons why banks are always going to have low price to earnings ratios is because of what their balance sheet looks like. And what it looks like is they have a lot of loans on their balance sheet. And these loans, if there is, some slowdown in the economy or something happens macroeconomically that causes a lot of these loans to go bad, then suddenly those earnings that the company is showing could get decimated quite quickly if they're forced to take a massive loss on all those loans, if a lot of people can't pay them back, essentially. So that's why you're always going to see banks have seemingly very low price to earnings multiples compared to, say, a technology company. You just can't really compare them. They're just vastly different businesses. So this is their balance sheet here. And if we look at their total assets right now, it's about $34 billion in total assets, and 31.5 billion of that is just in loans. So like I said before, the loans is really what makes your investment in here. So we can see it's been growing again at a pretty strong clip. I mean, it's growing every year. So this is exactly what you'd want to see in a bank. This is where growth comes from in a bank, is the ability to increase the amount of loans. Okay, so the next thing I want to do is get into the valuation. Now, it is a bank, so we cannot use a discounted cash flow analysis to value this company. So what I'm going to do is use a very simple method to value them. But before I get into that, we need to look at a few key metrics first. And one of those metrics is return on equity. So this is a pretty important metric to look at for banks because equity is another term for book value. I mean, they're basically the same thing. And then return on equity is basically the bank's profit divided by their book value. So it shows how much money they're generating versus how much book value they have. Now, what you want to see is obviously this to be as high as it can. And from what I've seen for banks, especially banks in Canada, they usually are in the 15 to 17% range. So we can see with Equitable, it looks like they're right on par there. So it kind of fluctuates a lot. We can see 17%, 2013. That was particularly high. It's usually around the 15% range. And management has even said that their target is 15%. So I'm just going to assume 15% average going forward. Another metric I'm going to use is the price to earnings ratio. Now, normally I avoid using this metric. However, with financial stocks like banks and insurance companies, I am okay with using it just because a lot of those accounting adjustments that can make a price to earnings ratio misleading for a regular company are actually valid to consider for banks specifically. For example, if they have to take a large write down in the value of their loans because, say, a lot of their customers are defaulting, that's something that's a valid inclusion in those banks' earnings. So when you look at the price to earnings ratio for Equitable compared to a lot of other banks here in Canada, you can see it's lower than all of them. So there's a bit of a disparity there, especially when you compare it to the much larger banks. Theirs is only just under 8. This is the next 12 months, by the way. So it is a projected price to earnings ratio. The next lowest one would be Laurentian Bank, which is just at 9.1. Now, normally when you see a large disparity in a valuation metric like this, there's usually a reason for it. It's usually not just because investors are asleep at the wheel and just can't understand the value that's slapping them right in the face here. There's probably a reason for it. And after doing a bit of research on Equitable Group, the reason for it, in what I believe is the reason for it, is just they're not as diversified in their loan portfolio as some of the much larger banks. And they're particularly very exposed to what they have here, SFR Alt, which stands for Single Family Residential Alternative Mortgages. So this represents $13.3 billion. And remember, they're only valued about $2.3 billion as a company overall. And they have $13.3 billion in loans outstanding to alternative mortgages specifically. So they're hyper exposed to Canada's mortgage market. So if there does happen to be some type of economic slowdown and people can't pay their mortgages, or there's something that happens in the housing market and not as many people are able to sign up for these types of mortgages, then there could be a really sharp decline here. So I think the reason you do see this PE ratio much lower is just because they're not as diversified. And if you're wondering what these alternative mortgages are, they're basically a type of mortgage where if you don't qualify for a mortgage at one of the larger banks because you don't meet their requirements for the credit score you need or the income you need, then you can get an alternative mortgage. And it is a bit of an interesting market because Equitable is one of only two, I believe, businesses in Canada that offer alternative mortgages. So you may see it as a particular competitive advantage because if you think that alternative mortgages are going to be very popular in the future, then this could be a massive benefit for Equitable. Or you could see it as a detriment to them because they are very exposed to this $13.3 billion. So you can look at it two ways. So we can put these measures together to get a rough idea of the valuation. So I'm going 7 years out. So I'm going into the year 2027, going off of the most recent full year of financial information they reported, which was the end of 2020. So I took number one, the book value growth rate, the return on equity, price to earnings ratio, which would then give us the market cap. You divide that by shares outstanding, and then you get a price per share. And then we can compare what the average annual return would be based on the current share price, which is about $69. So I have a low, middle, and high different assumptions here. So it starts with book value growth rate. Now, they've been growing their book value at 14.5% for the last 10 years and 15.7% in the last 5 years. So as a low, I went 13, middle is 14, and high is 15. So even 15 on the high end, not super aggressive, still definitely plausible. And then we talked about return on equity before. They're aiming to have it in the 15% range. It's historically been that, although some years it was higher and some years it was lower. So again, just went from low, middle, and high there. Price to earnings ratio, as we saw, I went very low on the low end, only 6, 7, and then 8, because I don't want to have my whole investment success based on the fact that their PE ratio just expands, because we don't know if that's going to happen, right? And this has historically been where it's at. So I think these are reasonable assumptions. So then that gives us a projected market cap. And then we just divide that by shares outstanding, and then we get to the price per share. So under the high scenario, if you believe these assumptions here, you get about a 13.5% annual return over the next about 6 years. So that's a pretty good return. But in the middle, you get 8%, which is still decent, but in the low, you only get 3%. So if we assign probabilities to each of those returns, personally, I think that the high scenario is more likely than the low scenario, which is why I assigned 30% as opposed to 20%. And then if we do an expected value of that, we get just under 9% expected return over about a 6 or 7 year holding period. Now, an 8.7 expected return may not strike you as extremely high, but when you compare that to the valuation levels of a lot of stock market index funds, they tend to be very tech heavy, right? They have a lot of technology stocks. For example, if you're to look at the S&P 500, it's very heavily weighted into companies like Tesla, Microsoft, Apple, Google. And those companies are valued quite aggressively right now. So if you're someone who thinks that valuations are currently very stretched and there's probably going to be a pullback in the future, which could lead to all these stock market index funds like the S&P 500, XEQT is another one. Those could have, not great returns over the next decade. Then maybe an 8.5% return looks okay, and a company like this provides pretty good value at a time where a lot of stocks just don't seem to provide that great value. Now, no discussion about a bank stock would be complete without discussing the impending interest rate hikes. Now, the Bank of Canada came out recently and said that they're not raising their interest rates yet, but it seems likely they will do that at some point in the future because the economy does appear to be quite strong. GDP is up, unemployment is low, and things overall look good. And rising interest rates can sometimes be good for bank stocks because it can increase their net interest margin, which we talked about before. However, with Equitable, it probably won't have that much of an effect because if we go here to look at their actual net interest margin, we can see it's about 1.8%. Now, let's look at what it has been historically over the past, about going from 2017 to 2008. So historically, it's actually quite high, at 1.83%. It's kind of in the 1.5% range. It was a bit lower down here. Hasn't really fluctuated a whole lot. It's gone from about 1.8% at the high to about 1.4% at the low. And throughout this whole time period, interest rates fluctuated to many different levels. Obviously, they were much higher at points throughout this time period than they are right now, whereas right now they're basically as low as they can possibly be. So don't invest in Equitable under the assumption that rising interest rates are going to be this huge catalyst for this company. Other factors like growing their deposit base and then growing their loan originations are far more important in determining whether or not this company is successful than whatever the Bank of Canada decides to do. So let's conclude everything we've talked about now. Now, personally, my personal opinion is I do actually think this company seems like a pretty good investment. I would not be surprised if they did continue to outperform the market over the next 5 to 10 years. Obviously, not financial advice, just my personal opinion based on what I've seen, because it does appear that they're growing their customer base very fast. They are one of only two companies operating the alternative mortgage market in Canada. They're rolling out many new products and services, which appear to be doing quite well. And I think this is a company I'm going to continue to do my research on because I like what I've seen so far from them. It does seem like it's an interesting company that I would like to learn more about. So I might do a follow-up video on this company later on discussing, additional things I discovered about them. But if anyone has anything additional they'd like to share with this company that I didn't cover in the video, feel free to drop a comment and let me know your thoughts. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening. I hope you did find it useful. If you did, leave a like and subscribe if you're new to my channel and you enjoy this type of content. And I will see you in the next video.